Hello and welcome to the first podcast of 2025. Happy New Year to you all. My name is Michael Hewson, introducing this Good Money Guide podcast in conjunction with Pepperstone. And Happy New Year to you, Michael, who we will both be chatting about the performance of the banks, the performance of the oil and gas sector, and maybe we'll do a little bit of a retail to set us up for next week, when we'll hear the Christmas trading numbers from the likes of Tesco's, Sainsbury's and Marks and Spencer's and a variety of other retailers like Next.
Indeed, yes. Very happy New Year to you, mate. Here we are, 2025, and about to do it all over again, aren't we?
Yes, indeed. Though I must admit, I'm in the very nice situation of having stepped off the treadmill for a good part of last year to recharge my batteries. I know I said that last week, but I must admit I do feel fresh, but I also completely empathise with you, and I know how hard it is and how much the job takes out of you.
But we love it, really, don't we?
Well, we do. I mean, crikey, I wouldn't have done it for 15 years if I didn't enjoy doing it. But there comes a time when I think sometimes you have to basically take a step back and smell the roses, smell the coffee, and what have you. Even though it wasn't completely my decision, but it's a decision that I'm very comfortable with.
Indeed. Am I going to have to remind you to read that disclaimer again?
You're not, because it's right here. So. Before we get started, I'd like to thank our sponsors again, Pepperstone. Pepperstone Markets, we're a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. Before I get started, I'd like to read the disclaimer. I really should know this off by heart, but my brain is so full of clutter that I don't feel I need to clutter it up with anything else. So. They're going to kill me for saying that.
They really are, mate. They're going to start getting me to read it. That's how bad it's getting.
Anyway, let's go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product, or instrument, or to participate in any particular trading strategy. We advise any readers, viewers, or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 75.1% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so Michael, what do you want to start with? We did. What do you want to start with? Oil and gas, banks, or I think we'll finish with retail because obviously we've got the retail numbers next week. But I think, banks have done very well. I think this year, well, three of them have. Lloyds and HSBC, not so much. Not really sure why HSBC haven't done very well. Lloyds, not a surprise because of the concerns about Black Horse Finance. But Good Money Guide did something on Lloyds a few weeks ago. Could the share price go back to or go back towards £1? And it was rather timely in the context that I think it was a week just before the share price tanked from 63p to 50p because of concerns about the Black Horse Finance thing. But for me, I see no reason why Lloyds can't bounce back from that. Because when you actually look at the rest of the banking sector, and you've got banks like NatWest, which in 2023 endured a little bit of a PR disaster with the departure of Alison Rose and
yes, of course,
and then Howard Davis left in 2024, and I think he hung around way too long. I think he should have gone along with Alison Rose. Nonetheless, I think they've drawn a line under that, and ultimately the bigger question for me is, they've put on over 75% year to date. Is there any much more upside?
Well, I guess that's the question you ask, isn't it? When anything, whether it be a bank or any equity, has rallied by that much over the space of a year, you think firstly what's driven it, and secondly, can that continue to drive the market higher? And actually with something like this, you kind of go, maybe a lot of the good news is priced in at this stage, and maybe that it is going to perhaps limit some of the further upside. I think Lloyd's is certainly a more interesting one, though, given that some of the Black Horse issues do appear to be in the process of being put to bed, and perhaps that's not going to be as bad as markets first feared, and that could perhaps open the scope for a bit of a relief rally, if nothing else.
Yeah, I think in terms of Lloyd's, a lot of the bad news is probably priced already.
Mm.
And unless there are any significant surprises, then 2025 hopefully will be a better year than 2024. I'm looking at my comparison chart now, and Lloyd's hasn't done badly this year, not by any stretch. It's just that Barclays and Lloyd's and Standard Chartered have done even better.
Mm.
And I think that's sometimes it's very easy to lose sight of that fact. But if you look at 2023, for the banking sector, Lloyd's and Barclays and NatWest didn't do very well at all. So maybe there's a little bit of catch up from a little bit of underperformance there.
Yeah,
but Lloyd's haven't been doing well for about 4 or 5 years. So, at some point you got to think, margins are getting tighter. Interest rates are coming down. The banks are a barometer of the UK economy. And, let's not beat about the bush here. The budget imposed an awful lot of extra costs, not only on businesses, but banks as well, because they employ a lot of people.
Yeah, absolutely. It's interesting you mentioned Standard Chartered, actually, though, because they have traded well. They did trade well in 2024, but they are considerably different to their peers in that, yes, they are London listed, but they are much more heavily focused in Asia and the Middle East and some of the emerging markets, in a similar way to HSBC. Actually, and there's been a little bit of divergence between those two over the last 12 months or so too, which has been interesting because obviously HSBC are now going through over the year ahead this big restructuring and trying to split the business up into various divisions once again, and you wonder whether that could perhaps unlock some upside in the share price if that all goes to plan and unlocks the value that they've promised.
Do you think that they will spin off the UK bank? I mean, they're already putting the building blocks or the foundation blocks in place. And while they've denied that that's behind their thinking, their biggest Asian shareholder, Ping An, has been pushing for a split between the Asia Bank and the European. And they have been selling off, the French operation, the US operation. The UK bank is very profitable. First Direct, HSBC as well. I mean, First Direct was the first online bank.
Yeah, and, they were. Yeah.
I was looking at the numbers, and they're still looking to make another £300 million worth of costs. So you sort of think there's a political aspect to this story as well, given the relationships between the Chinese government and the UK government, and the way that HSBC treats its Hong Kong clients.
Well, yes,
which
and
they've
also
come under criticism for.
Yes, quite, and also the identity of the activist investor that's pushing for this as well. Don't forget that. But it's certainly possible. As you say, they do seem to be sort of teeing themselves up to do that. I guess the question is, if you spin it off, what do you do with it? Does someone else look to purchase it? In which case, the competition authority will be all over it. Does the UK entity get listed as a separate entity in London, and the remainder of HSBC stays in Hong Kong? There's a lot of question marks around that.
I think your latter point there would probably be the most obvious option, because essentially, you'd be going back to the way it was before, when it was Midland Bank, when HSBC took it over back in the day. So, politics can be a very strange animal, and ultimately, I think you do. You do what's pragmatic. And if it solves the problem, then they might spin it off. The bigger question is how much is baked in terms of the valuation for the UK operation relative to the Asia operation, and how would you do that? I mean, but I certainly think you'd have banks queuing up around the block to bid for that. Yeah,
absolutely.
Okay, so I think in terms of the banking sector, for me, I think the key risks, particularly for the UK-focused banks like Lloyd's and NatWest, it's really how the UK does and the UK economy does. And I think the problem we've got at the moment is I think there's a danger that we could be heading towards a minor recession, given some of the data we've seen in the back end of 2024. The economy contracted in Q3. I think there's a decent chance, given the recent PMIs that we've seen, that we could do the same in Q4.
Yeah, absolutely. I would agree. And actually, I'd be tempted to take things one step further and say worse than a recession, you could actually be dealing with stagflation in the UK. It's certainly in the first half of 2025. The economy it's not growing at all. And even when we are seeing growth, it's very, very anemic and concentrated very tightly in a handful of sectors. It's not broad based. Risks to the labour market are tilted to the downside, given the national insurance changes that you alluded to. And then in terms of inflation, of course, we've still got services prices north of 5% and core inflation running at 3.5%. So, we've got a really toxic cocktail here in the UK of high inflation, which is not just high inflation, but stubbornly high inflation. Sticky and very, very weak economic activity. And I think that is going to be a very difficult one for all UK firms to deal with, and for policymakers to try and grapple with as well.
Yeah, I think there's also the fact that a lot of these 5-year fixes now will start to roll off. And how that, they're sort of pre-COVID ones, because obviously 2025, interest rates post-COVID were very, very low. And anyone who fixed in and around that time, you've got a long tail. I think, if you like, the 2-year fixed rates have probably more or less rolled off now. And now you've got the 5-year fixed rates. And that could potentially put further pressure on the housing market. And house builders, which have had a diabolical year this year, they're all down. Every last one of them: Barratt, Barclay Group, Persimmon, Vistry Group, which issued a profits warning in September, actually issued 2 or 3 in the last quarter of last year, and then
got kicked out the FTSE.
Yeah, and it was 40% up in September, and now it's down around about 20-25%. So, there's this new house building program that the government wants these house builders to embark upon, but is the labour there? Is the raw materials there? And the planning system. So for me, it's all very well talking about 1.5 million new houses. Who's going to build them?
Yes, exactly. Because at the moment, it doesn't look like anyone's going to build them. No. And that's before you tackle the issues that we all know about with the planning system as well. But that could be a podcast in and of itself, I think.
Yeah. So obviously, house builders underperformed last year. Banks did very well. I think the bigger question is, as we head into 2025, is how resilient will the UK economy be? And I think a lot of that will determine on how well the banks do, because ultimately they are still fairly profitable, and there's nothing to say they can't continue to do so. But how will they stay profitable? And I think for me, what we've seen, particularly around where I live, is branch closures and automation. And the last budget, I think, will only accelerate that process.
Yep, and I don't think the banks will need much by way of persuasion to accelerate that process. So I would fully agree with you on that. And I think that trend is only going to accelerate. And
equally for retailers, we've done quite well. Tesco's share price had a very good 2024. It's up around 45%. Sorry, not Tesco's. Marks and Spencer's, and Tesco's is up just under 30%. Sainsbury's is down slightly, but the only reason Sainsbury's is down is because the Qataris sold off a big stake.
Yeah, I was going to say there's some idiosyncratic issues with Sainsbury's, isn't there? So,
but yeah, I mean, it's still a fairly well run retailer. But we've jumped ahead a little bit. Okay, so those are the banks. The oil companies, which is another big key component of the FTSE 100, and one of the main reasons I think why we've underperformed again this year. And I was looking at my oil companies chart, and it's interesting that the performance has sort of tracked the oil price. So I think if one thing we can be grateful for, there is a silver lining to the underperformance of the oil companies, is the fact that fuel prices have actually not gone up to the levels they were in 2022 when Russia invaded Ukraine. That's
very true. That is very true indeed. I think from you look at crude, and actually there isn't. Personally, I don't really see much by way of case for upside in crude prices over the short term. At the very least, the demand outlook remains very, very dour indeed. Certainly, when you look at global manufacturing, the PMI surveys that we get every month point to continued contraction pretty much across the globe, certainly in Europe, where we know Germany's issues with the manufacturing sector are now very, very deep rooted and structural in nature. Yes, I guess the silver lining is that we get a little bit of cheaper petrol at the pump. Obviously, the downside is that we see underperformance in these oil and gas stocks, and as a result, given their concentration in the index, underperformance in the FTSE as well.
Yeah, I mean, but France is also posted some really weak manufacturing numbers as well. So I think when you've got the two biggest economies in Europe, seeing that sort of manufacturing activity on a monthly basis, yes, it's bad. Does it speak to structural issues, or does it speak to just weakness in general in terms of global manufacturing?
Potentially, I would say it's more of the former though. When your manufacturing industry is contracting for 2.5 years non-stop, I think it's pretty tough to argue that that's anything other than a structural change in the economy or even a depression within that sector.
Yeah, I mean, I was looking. We hear an awful lot about oil prices, and we hear an awful lot about gas prices, and oil prices are now lower than they were at the beginning of 2024. And yet the UK pays the highest electricity prices in Europe. How do you square that circle?
I'm not sure you can square that circle, to be completely honest with you.
I think it's the way we
calculate.
Yeah, well, it's the way we calculate electricity prices in this country. It's absurd.
Yeah, it is.
Absurd.
And now, of course, we're going down the route of green energy, aren't we? So.
Which is more expensive than fossil fuels at the moment.
Well, yes.
I mean, you hear this about, wind energy is free and, solar power's free. Well, yeah, it might be, but you still got to build the solar panels. You still got to build the wind turbines, and then you've got to get it to the grid. So it's not free.
No, and of course, what happens, like we had last year in October, November, when we have days where there is no sun and there is no wind. What do we do then?
I suppose we could plug Ed Miliband in and use the hot air that comes out of his mouth. Just a thought.
That would power several million homes, I think.
Yeah, probably would. So, I mean, basically what we've seen here is another year of lower profits and higher taxes, because I think that's one of the things, the windfall tax on the UK companies has gone up. So that essentially their effective tax rate is around about 80% on all their UK profits. And the fact that essentially the government has scrapped new oil and gas licenses, and most of the new development hasn't actually been done by the big oil majors. It's been done companies like Harbour Energy, by Serica Energy, and by Enquest.
But where's their incentive?
Well, there isn't, because essentially once Harbour Energy was basically formed out of the ashes of Cryasor back in 2016, 2017, and had £2 billion worth or $2 billion worth of debt, which it's now all paid off. First year it made about $2 billion in profit. And you think about all the investment that had gone into basically building those, getting that oil and gas to the surface, all of that sunk cost. And their first year where they were able to make a return, they got taxed at 80%. I mean, it's just bonkers.
Well, and that says it all, doesn't it? That is just a punitive measure. Now they're going to stop O&G exploration anyway. But even if they weren't going to do that, you may as well have done by just jacking taxes up that high.
Yeah, I mean, actually, I'm looking at my chart. I mean, Harbour Energy's share price took an absolute surge at the end of last year because of the fact that it took over I think it was Wintershall Day business. Yeah, Wintershall Day business, which was announced not this time last year, at the end of 2023. And it included assets in Germany and Norway, as well as South America and the Middle East. It's diversifying away from the UK. Yeah, there is absolutely no point in it investing in the UK. And
they're certainly not going to be alone in doing that, I don't think.
Yeah. I mean, most of its revenues were generated by crude oil for 1.11 billion and gas, with the bulk of sales coming from its North Sea operations. International revenue for Harbour accounted for a mere £98.1 million. £98.1 million. So over $1 billion was taxed, or in terms of profits was taxed. It did turn a profit, a very small profit, of around about 100 million quid, but it lost most of that because of the windfall tax. So is it any wonder they're basically going abroad? And Harbour Energy is the type of company that we need to keep in the UK. So is it any wonder when we were talking about last week the fact that so many companies have delisted or moved their primary listing? That's why.
Absolutely. I could not have put that better myself, mate.
Anyway, we'll finish up now. Let's do retail. Been a bit of a mixed bag, retail, this year. There's been some success stories, but generally it's been a difficult year for retail. Marks and Spencer's obviously is the standout performer. Next has done reasonably well, but Next almost appears recession-proof. And I've looked at the Next performance over the course of the past few years, and it always seems to bounce back. It always seems to raise its guidance. How does it do it? A well-run business.
I was going to say that's all you can say. It appears to be a very well-run business. I'm certainly not one to comment on their style or their fashion offerings, as anyone who's watching this on video can testify.
But you go into a Next store, Michael, and there are plenty of them about. They're always clean.
Well, I was going to say they're always clean.
Dated. They don't look dated.
And they're always busy as well. It is, I think, just an example of a very, very well-run business, and they are rewarded for doing that.
Yeah, you've got JD Sports and Frasers Group, who are both also very well-run businesses, and they've taken an absolute hosing, over 20% down in 2024. And I think maybe that's because maybe investor expectations are perhaps too high, or maybe in terms of Frasers Group, maybe they're spread too thin.
I was just about to say that. I think the JD Sports one is perhaps a case of not ever being able to meet the bar that investors had set for them. And I think the concern with Frasers Group now, Mike Ashley trying to buy effectively half the high street. The concern is, at what point do you say actually you cannot control a conglomerate of this size effectively and shepherd that business well, or to the degree that market participants want to see. So I think there are probably some concerns there around actually they've probably got their fingers in slightly too many pies at this moment in time.
Yeah, I think there's also a case for saying that if you've got your fingers in a lot of pies, you don't also have an awful lot of control over the costs of those businesses as well. So there's an awful lot of what I would call duplication. And in the words of, I think there's a big saying, put up or shut up. Either basically take the company over or basically get out of your holding and let the thing sink. So in the case of Boohoo and ASOS, you look at the underperformance for those, they've taken a little bit of an uptick in the past, sort of 2 or 3 months. For me, I think either needs to basically bite the bullet on them and either do a full-scale hostile or get shot of them.
Well, I think the other thing with Frasers in particular is, yes, they own a lot of companies and a lot of brands, but at the same time, they are not diversified at all, because all of these brands and all of these companies are in the same discretionary sector. So actually, you then look again and you say, fair enough, you've got your fingers in a lot of pies, but you can't control your costs. There's probably a few bits and bobs slipping under the radar, and you're very, very highly correlated across all of those brands. It's not a case of, if there is a slowdown, there are certain parts of that business that can insulate or make up for losses elsewhere. You would expect all of those to sort of move in line with each other.
So because they're all consumer discretionary.
Exactly.
So and what's the first thing to get cut?
Mm-hmm.
It's food on the table that comes first.
Yeah,
maybe your mobile phone bill second.
But you look at the outlook.
Got to do those TikTok things. You've got to do those TikTok things. Got to still do them.
But you look at the outlook for next year, and we've sat here and discussed at length how dour things are looking.
Doesn't mean that companies won't do well.
No, I agree. But if you're sat there trying to position yourself for what could be a pretty grim 2025 from a UK economic point of view, you're probably not going to be loading up on the discretionary sector.
No, maybe not, maybe not, but you could certainly pick one or two that will probably do reasonably well. I think sometimes looking for value, I mean, people say you're looking for value in all the wrong places. Well, I suppose it really depends on how you define value. But on the outlook, for Marks and Spencer, CEO said the business was on track to deliver £500 million in savings by full year 28. Although he did issue a cautious outlook, but it doesn't appear to have tempered investor enthusiasm for Marks and Spencer shares. So, at the end of the day, if a brand is good, what's the first choice of any shopper when they want to go out and do some shopping? So food retail is generally tends to be recession proof. The only problem with that is obviously your competition. So you've got your Aldis, your Lidls, but then of course you've then got Tesco's and Sainsbury's are doing Aldi price matches.
I was going to say they're now starting to play them at their own game, aren't they?
Yeah, so. Exactly. So maybe there is growth there, or maybe it's an income stock. And as long as none of them issue significant profit warnings, then hopefully they will continue to.
Should be okay.
Yeah, indeed. Okay, so that's retail. Associated British Foods is another one of those companies that has a slight mix in terms of what it does. You've got obviously Twinings Teas on the one side, Sugar and Hovis, I think. And on the other side, you've got Primark.
Yes, of course.
So, and they have an agricultural business. So again, are they a retailer, or are they, I
think officially they are defined as a retailer, but again, going back to what we were talking about, they are considerably more diversified in their operations than a lot of the other retailers. So you may then go, actually, they could be better insulated against any potential shocks than some of their peers might well prove to be, because they have those other arms of the business upon which they might be able to rely.
Yeah, and yet they've slightly underperformed this year. They were around about £24 at the start of 2024, and they've dipped back towards £21 now. So, they're quite pricey as well in terms of the share price. I think if I'm an investor, I don't really want to be paying 22 quid for a share, because you need a lot of money to scale that.
That's very true. That is a very, very good point.
And I think coming at it from an investor, sometimes you don't want to pay a lot of money for an individual share. So Rolls-Royce in 2022 was 80 or 90p. So you can buy quite a lot of shares for that, and now they're £5.70. So if you got in there, then your quid's in.
Yeah.
But you're going to need an awful lot of share price upside for Primark or Associated British Foods if they're 22 quid a share. So again, I think one of the things I tend to look for, and this is just me, and this is not investment advice, by the way, but I tend to look for a share that's not particularly expensive, but which can scale quite well. And that's one of the reasons why I like Lloyd's, because for me, in 2017 it was 85, 90p. Now it's more profitable, its margins are better, and yet it's 55p. Where's the logic in that? So
actually you then have what on the face of it would appear to be a relatively obvious mispricing.
Yeah, you would think so. But then again, you then need other people to think that.
Yes.
A share can be mispriced for years, and then suddenly it comes on the radar. Now, what puts it on the radar? Now, a great example of a mispriced share, well, it's not a great example, because it's actually a rubbish example, but it gives you an indication of how...
But you use it anyway.
But I'm going to use it anyway, because it's an indicator of how sentiment towards an asset can change the entire trajectory of that asset. One word: GameStop. It's a basket case. It's an absolute basket case, right? But sentiment towards it changed and basically drove it in completely the opposite direction. So it was mispriced on the downside, and then it was completely mispriced on the upside. And that's my point. And I'm not saying Lloyd's is like GameStop. Don't. It's not. Okay. But what I'm saying is, I think that it's potentially mispriced.
No, and actually that is a good example, because it does show the power of how sentiment and changes in sort of collective belief can and does influence moves in share price. Obviously, that's an extreme example.
It is an extreme example. I couldn't think of another one. But
to what you're saying.
But I think in terms, sometimes they're the best examples.
Yeah. No. Exactly.
So Lloyd's hasn't dropped below 50p in the wake of obviously the Black Horse Finance. If we get a good outcome there, then I'd like to think we could start to edge back up again. But who knows what the rest of the year will bring. I guess we'll just have to wait and see.
We will indeed. We'll know in 12 months' time.
Well, we will. We'll probably know before that.
True.
Hopefully if we do more of these videos. But for the here and now, I think we pretty much covered everything that we needed to cover. So, given that this is the first one of 2025, Michael, it's been a pleasure to say Happy New Year to you.
Yes, Happy New Year.
And next week we'll probably cover the results of basically the post-Christmas results of the likes of Marks and Spencer, Tesco's, Sainsbury's, and Next, assuming that we have them at our fingertips when we next sit down and chat.
Indeed. Very much looking forward to it, mate.
And hopefully they'll paint a picture that's more positive than the one we feared might be the case in the absence of those retail sales numbers that we saw just before Christmas.
Well, let's keep our fingers crossed, eh?
All right. Well, okay. Well, as I say, I think we'll wrap this up for the first one of 2025. Thank you very much for listening, ladies and gentlemen, and we'll probably see you all the same time, same place next week. And thank you, Michael, once again for your insightful contribution.
Thank you, mate. Bye-bye.
Bye.